Today I would like to analyze Snowflake, one of the largest cloud-based data storage company in the world and one of the best performing stocks in the last month. We are up around 25%. If we're going to take a look at the 5-year charts, we are down around 16%. So we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 66.74 billion US dollar. This makes Snowflake the 23rd largest software company in the world by the market cap. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and on a declining business. So in 2021, the revenue was around 0.6 billion US dollar. This was an incredible growth, around 123% from 2020. In 2022, we saw the incredible growth again, around 106%. Then in 2023, we saw the very good growth, around 69%. In 2024, we saw the very good growth again, around 35%. So we can see the growth is slowing down, but overall we had the incredible growth in the last 5 years, so it's a check here. The next thing we're looking for is free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2021, the free cash flow was around 0.08 billion US dollar in the negative. Then in 2022, we saw the positive free cash flow around 0.09 billion. Then in 2023, we saw the very good growth around 453%. Then in 2024, we saw the good growth around 56%. So overall, what can we say? We had a good free cash flow growth in the last 5 years. So it's a check here as well. The next thing we're looking for is a free cash flow yield over 4%. This can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024, 0.81 billion US dollar. We're going to divide it with the current market cap, 66.74 billion. Then we're going to get a free cash flow yield for 2024. So the number we're going to get would be around 1.21%. And that's quite low. Actually, it can be an indication for overvaluation, but of course it's still a young company and they want to grow the free cash flow as well in the future. It's not a check here, but we can also take a look at the free cash flow assumptions for 2027. We can see here in 2025 around 0.9 billion US dollar, in 2026 around 1.1 billion US dollar, in 2027 around 1.4 billion US dollar. So let's assume for 2027 around 1.4 billion US dollar in free cash flow. Then we're going to get a different number. We're going to divide it with the current market cap. So the number we're going to get for 2027 would be around 2.09%. And that's still quite low actually. It's not a check here as well for 2027, and this could be an indication for overvaluation right now. Let me know in the comment section if you think these numbers are realistic. The next thing we're looking for is the debt to free cash flow ratio under 5. This means the company can repay the debt with a free cash flow in under 5 years. A very important number because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. We can see here around 2.27 billion US dollar. And then we can see here as well, we not have a short-term debt. So then we're going to divide this number with the current free cash flow, 0.81 billion. Then we're going to get the debt to free cash flow ratio that we're looking for. So the number we're going to get would be around 2.8. And that's a good number. Actually, it means a little bit under 3 years we can repay the debt with the free cash flow. So there's a check here. We can also take a look at the cash on hand, how much money this company has in the bank. We can see here around 4.64 billion US dollar. And that's a huge amount actually. We can repay the debt already with this amount and we can also invest in the future. So overall, I think this company has a very good balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. First, you're going to calculate the enterprise valuation. This is the current market cap, 66.74 billion US dollar. We're going to add the debt, 2.27 billion. We're going to take minus the cash, 4.64 billion. So then we're going to get the enterprise valuation of this company, how much the whole company is worth. So this is around 64.37 billion. This now we're going to divide with the current free cash flow, 0.81 billion. Then we're going to get the ratio that we're looking for, 79.46. And yes, that's a high number. We want to see that number under 25. So it's not a check here. But of course, this is a young company. They want to grow the free cash flow a lot in the future. We can also calculate this for 2027 with a higher free cash flow. So 1.4 billion for the free cash flow. Then we're going to get a different number for 2027. So the number we're going to get would be around 45.97. So this is already a better number, but still quite high, I would say. So overall, I think we need to understand this company has a very high revenue growth in the last 5 years, but also the valuation seems to be quite high. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially we think the company is undervalued. So we can see here, actually the shares outstanding did increase over the last 5 years. This is quite normal for a technology company, but also for a young company that wants to grow in the future. But if we take a look here, we can also see the stock-based compensation is quite high. In 2025, they pay around 1.48 billion US dollar for the stock-based compensation. This means they pay the employee with the shares. So overall, this is something normal for a technology company, but it's also affecting the free cash flow in some way as well, because it's not considered in the free cash flow. So if we want to buy back the shares, we use the free cash flow then. So overall, I think it's not a very positive thing at the moment, and not a check here as well. Can Snowflake stock be a good buy right now? So this company had a great revenue growth in the last 5 years, sometime even over 100%, and the next years is expected to grow around 30%. They also have a great free cash growth in the last 5 years. This is something we really like to see. The balance sheet is also looking good. This means a low amount of debt and a good amount of cash on hand. What we don't really like to see is the low free cash flow yield around 1.21%. It's an indication for overvaluation. For 2027, with our free cash flow assumptions, the free cash flow yield would be around 2.09%, which is still quite low. We want to see that number over 4%. So the enterprise valuation to free cash flow ratio around 79.46 is also very high. We want to see that number under 25. So then in 2027, with our free cash flow assumptions, this number would be around 46, which is still quite high. Then we also have the stock-based compensation. This means the company pays the employee with the shares. This is around 1.48 billion US dollar in 2027. So they pay a huge amount for the shares. And this is something we don't really like to see. Of course, it's normal for a technology company, but it's also a hidden cost. So overall, I think this company is not really a good buy right now. If you found this video helpful, don't forget to like and comment and subscribe for more content.